Hello there. Well, obviously the news this year in financial markets has been really dominated by the US trade tariffs. Now, if you listen to Donald Trump, you would think that it's somebody else outside of the US who pays the tariff. So if they levy a tariff on Chinese goods, for example, if you listen to Donald Trump, you get the impression that it's China who pays those tariffs. But that's not the case. So a tariff is a tax on imports. So it's whoever imports the goods that pays the tax, which ultimately means that essentially it will either be, most of the time, a US company or a US consumer who pays that tariff. Now, at the start of the year, the sort of average tariff on goods imported into the US was about 2.5%. Now, after all of the negotiations, it's about 15%. So despite the kind of, all of the kind of the ructions and the trade negotiations and everything that's gone on, and it has settled down to a level that's quite substantially higher than the tariffs were before this year. Now that, we think, is going to have an impact. As I say, somebody in the US is going to pay that tariff somewhere along the line, whether it's the consumer or whether it's a company. So if it's the consumer, that could lead to higher inflation. If it's a company, it will lead to lower profit margins. Now, it is worth remembering that a tariff is only paid on goods. It's not paid on services. And goods or manufacturing and all those non-services activities actually only add up to about 18% of the US economy. So you would think that the impact on inflation could be quite limited. Now, of course, there might be a bit of a pass-through because even some of those services companies, for example, people like Netflix, they do have hardware costs as well. But perhaps that might be passed on with a bit of a delay. Now, so far, all the evidence is that actually it's the companies that are paying the tariffs and not the consumers particularly. So we're not seeing a big impact on inflation yet. It could happen further down the line. And that's partly because those companies are currently making essentially record levels of profit margin. Since COVID, profit margins in the US have absolutely jumped to massive levels. And that's partly because of some of the government support that they got during COVID. So perhaps if they're going to sort of absorb some of the impact of the tariffs and not pass it on to consumers, perhaps that's almost paying back some of the support that they got during COVID. So whatever the results and how it ultimately ends up, at the moment, tariffs haven't yet had an impact on US inflation, and they're maybe only having a small impact on profit margins, but we do think that might get more substantial as we go on. So that's a bit of a risk to the US economy and the US stock market, because if companies making less profit, then of course that's not very helpful for their share prices. So that's one of the reasons we're slightly wary about the US market. The other reason is because it's pretty expensive at the moment as a sort of a multiple of the profits being made by companies. It looks quite stretched. So we're cautiously optimistic about it, but as we've said before, we still think one of the things we can do is we can still invest in the US, but we can do so in different ways. So invest in via defined returns, for example. And we can also have some sort of insurance policies, if you like, in the portfolio that we think, whilst we still want to invest in US stocks, if they do pull back, then we've got something else in the portfolio that hopefully should rally and do well. Because markets have actually done remarkably well so far this year, despite the kind of the blip and the volatility we saw around Liberation Day. Hopefully that continues, but we just have to be a little bit wary in case we see any further kind of developments and volatility to come. So I hope you found that useful. We'll see you again next time.